In this week's video, we'll examine the question, how significant was last week in terms of damage to the bullish trends in stocks? To help us answer this question, today we'll look at the current market relative to pre-correction points in May of 2012 and October of 2012 using several charts and several indicators. We'll close with the CCM Big Four. In last week's video, we noted in an environment where central banks are flooding the financial system with printed money, that outlier events or strange market behavior is more likely, and therefore it's important to pay attention to what is happening and what is leading rather than trying to determine based upon a script or what we believe will happen. So in this week's video, we'll do just that. We'll look at what is happening. I can't emphasize enough in this environment where central banks have skewed interest rates, supply and demand in the bond market, supply and demand in the stock market. It's extremely important to maintain maximum flexibility. The charts look like they do now. That does not mean they cannot change rather rapidly or drastically in a short period of time where you have a lot of printed money floating around the system and a highly speculative bent to both the bond and stock market. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. It's important as investors that we do not try to follow scripts or look at historical patterns and expect them to repeat in the exact same way or even similar ways, but it is helpful to understand what a typical correction looks like and the psychology behind it. This is 2012, this is January. You have a strong uptrend here. Typically when you have a strong uptrend, you don't go directly from the strong trend into a sharp drop. Typically there's some peaking process or consolidation period here. You've got a strong trend. Your early adopters of the trend may start to take profits here, and then people that have been waiting for a dip may buy here. It's important to note that this retracement, this rally here, comes all the way back almost to the previous high. And why that's important is as long as your market continues to have strong internals and strong characteristics, it's not atypical to get a pullback and then somewhat of a retest of the previous high. And you can see here, this is a lower high. So it's possible from a psychological standpoint that if a correction is unfolding, we don't know that we're in this area here rather than in this area here. And what we'll do in this video is we'll compare today to this point here, which was May 4th, 2012. Why is that important? Well, this is the period that we want to avoid, and this is the period where we want to have a defensive allocation. From this close here on May 4th, 2012, the S&P 500 dropped 103 points, or 7.5% over the next 3 weeks. So this is what we're concerned about rather than this. Same concepts here, just taking a step back. This is again a daily chart. This is all of 2012. This is what we just looked at. This is your drop from the May 4 high. This is what we want to avoid. It was followed by a strong rally in a similar situation. Strong rally, peaking process or consolidation. So you get a sharp drop, retest of the previous high, a drop, another retest, and this is the period in here that we want to avoid, which is the sharp drop. From this point here, after the close on October 19th, and you'll notice here, on October 19th, look how close you are the previous day to the highs, meaning there's no need to really overreact in here. You haven't lost too much. If you held through this correction here, you came back up almost to the highs. If you held here, you came back up almost to the highs. This is what we want to miss. From this point here after October 19th, the S&P 500 lost 100 points, or 6.9% over the next month. So what we'll do now is we'll compare May 4th, 2012. This is a very vulnerable market from a technical perspective. And October 19th, 2012, a vulnerable market from a technical perspective to the close on Friday. Before we do the comparison, let's talk a little bit about what the comparison is based on. This is the correlation model that we built recently. We've discussed this in previous videos in recent weeks. These are the big four charts here that we'll cover today in yellow. If you want to know where the S&P 500 is headed from a probabilistic perspective, it's best to track the S&P 500 itself. These charts here are helpful in terms of helping us understand the market's risk-reward profile. But the further I get away from the S&P 500 and the lower I go on this list, the lower the correlation or the less meaningful these charts are to determining the health and probabilistic future direction of the S&P 500. So what this model does is it takes these charts, it allows us to look at numerous indicators, which we'll look at shortly, take all of this and look at the technical health of all these charts, weight them in a reasonable manner, and boil that down to one number. This is a lot of information. It can be very, very confusing. And if you can get it down to one number, it allows you to compare today to points in history. This is the weekly chart for the S&P 500 that's used in the CCM correlation model. See all the indicators as I scroll down that we use in the model. As you might imagine, if you're trying to make decisions on how to allocate your assets and the market's moving, this can be overwhelming. How do I make a decision based on all that? And then compound that with, how do I add in all these other charts and means of evaluation? And each one of these charts has a long list of indicators. The spreadsheet allows us to take all of this information based on all these charts and all these indicators and wrap our arms around it in a reasonable, well thought out, and prudent manner. Before we look at the composite score as of the close on Friday, May 24th, let's look at Friday's session. This is a 10-minute chart of Friday's session. This is Friday morning. This is the close on Friday. Note, weakness in the morning, the low of the day was made around 10:15, 10:10, somewhere in that area. And then the supply and demand balance for the remainder of the day allowed prices to move higher and allowed them to close near the high of the session. This was a similar look that we had on Thursday. The low of the day was made 9 minutes into the trading session on Thursday, and the remainder of the day, for the most part, was strong. So even though we had weakness last week and we lost ground, the daily movements may not have been as bad as they looked in the morning. So when we look at the composite score for Friday, it should be noted that the score was derived in the morning. So the technicals actually improved a little bit during the day, and the score that we have as of the close, which we have not scored yet, is most likely a little bit higher than the number we'll examine now. The composite score for all those charts and indicators on Friday morning, May 24th, was 81.88, which we could round up to 82. Just to reiterate, now we're comparing the close on Friday to May 4th, 2012, before significant declines, and October 19th, 2012, before declines accelerated. As we noted earlier, the composite score, if you round it up on Friday morning, May 24th, 2013, was 82 on a scale of 1 to 100. 100 would be the highest and the most bullish in terms of the responses and answers. A 0 would be the most bearish. 82 on Friday, you can see on the days where there was a higher probability of acceleration to the downside, so your risks were high, you can see the scores were much, much lower. On May 4th, 2012, composite score was a 17. October 19th, 2012, the composite score was a 33. What does all this tell us? It tells us that most likely, from the technical profile that we have currently as of the close on May 24th, we won't see an acceleration to the downside that lasts 1 to 3 to 6 weeks from here. Doesn't mean we won't see more weakness, but most likely if we see weakness, we would probably get some type of bounce back and retest of the previous highs, similar to what we saw in those orange boxes on the previous charts. It should be noted that a high reading, such as an 82 that we had on Friday, does not exclude a flash crash type scenario or an outlier event where you have a market with a strong technical profile that accelerates to the downside for 1 to 3 to 6 weeks. The point of the exercise is it's not a high probability that from this technical profile we would drop for 1 to 6 weeks and lose 7 to 10 to 20% from here. Can it happen? Absolutely. Anything can happen. But if that does happen, this number will drop rapidly over the next few sessions, and we'll still have time to react. To close out the video, we'll scroll through the big 4 charts that are included in the model that we just reviewed so you can get a visual as to why the score of 82 is high relative to those high probability decline points that we looked at in 2012. This is the S&P 500 weekly. This is the S&P. These are moving averages. The most bullish profile is when the market is rising, has a positive slope on a weekly chart. It is above the blue and red moving averages, and blue is above red. That's your most favorable conditions. Stocks rise. Conversely, most unfavorable conditions are price below, slopes of the moving averages rolling over and turning down, and blue crosses below red. This is what a correction looks like. See, there's a topping process, consolidation, correction. Your high probability for declines tends to occur when the moving averages are close together and then blue drops below. This is a red flag, correction. Bullish, moving averages start to get closer and closer. You get a bearish cross in here, declines accelerate to the downside. So let's compare this high probability decline point here and this high probability decline point here to the close on Friday, May 24th. This looks nothing like this or this. So more deterioration needs to happen. Price is still above both moving averages. The slopes of the moving averages are still pointing up, and blue is still above red. Could we morph into something like this? Sure we can. But the way we manage is we don't anticipate what will happen. We look at what is actually happening. And what is actually happening is, if you were to ask the question, is this still a healthy chart? The answer would have to be yes. It still looks like a healthy chart. One of the charts in the CCM Big Four helps us answer the logical and relevant question, would I rather be long or short? To answer that question, the model uses a weekly chart of longs versus shorts. Consolidation period, correction. Consolidation, correction. Consolidation, correction. The game plan's the same as the previous chart. This is what bullish looks like. This is what bearish looks like. This is what bullish looks like. Bearish, bullish, bearish. Let's look at the present day. Present day does not look overly concerning. You can make an argument that the look here is similar to the look here. Blue above red, slopes of the two moving averages pointing up, price is ticking down a little bit here. That's what we have here. Is it logical to think that we might come back and retest this line? Sure it is. Is it logical that we might come back and retest this area here? Sure it is. We have to see more deterioration, become more concerned about this chart. So to answer the question, would I rather be long or would I rather be short? This is what I'd rather be long looks like. This is what I'd rather be short looks like. This still looks like, as it sits as of the close on May 24th on Friday, prior to the holiday weekend, the answer here is I'd rather be long. Another relevant question addressed in the CCM Big Four charts and in the CCM correlation model is, would I rather be in stocks or in bonds? To help answer that question, the model uses stocks, S&P 500, relative to bonds, AGG. Why do you ask the question, would I rather be in stocks or would I rather be in bonds? Cash currently pays almost nothing, and cash rarely wins, and cash does not trend. So if the answer to the question is, I'd rather be in stocks than bonds, and I'd rather be long than short, then the question is, where do you go? You don't go anywhere until the answer to that question changes from a probabilistic perspective, which it may or it may not from this look. This is what I'd rather be in stocks looks like. This is what I'd rather be in bonds looks like. Same concepts for all the charts. This chart, as of the close on Friday, May 24th, still looks like I'd rather be in stocks. Slope positive, blue above red, price above both. Not overly concerning yet. Could it morph into something like this? Sure it could. Or this? Sure it could. But we won't guess. We'll look for more deterioration. We'll take more defensive action if this begins to look like this or this, where weakness in the stock market followed. We'll close this holiday weekend video with the last of the Big Four charts. The first one was the S&P 500. Then we looked at longs versus shorts. Then we looked at stocks versus bonds. And the fourth chart is the credit markets. We'll look at junk or riskier or higher yielding bonds relative to more conservative long-term treasuries. This is risk on versus risk off. This is what risk on looks like. This is what risk off looks like. Should be noted that this has the lowest correlation relative to the Big Four charts we just reviewed, and thus is the least important of the four relative to trying to determine the probabilistic direction of the S&P 500, which is shown here where my cursor is moving. This is what risk off looks like. I've highlighted here, this is where declines accelerate to the downside in the stock market. Notice what this chart looks like. It has a bearish profile. This is where declines start to accelerate to the downside for the S&P 500. Notice what this chart looks like. It has a consolidation look to it. Much lower high, sideways consolidation look. Blue is very close to red. Price has actually dropped below the moving averages twice over the past few weeks. Question, does this look like this or this, where declines in the stock market accelerated to the downside? The answer is no. This chart still sides, as of the close on May 24th, with bullish outcomes. Could it morph into something like this or this? Sure it could, but we won't guess. We'll wait for deterioration to actually take place. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.